Hello, they call me Mr. Fed. The last week's events, this is April 13, 2008, remind me of a very famous Churchill quote, Winston Churchill. He was referring to a famous battle, and he stated, "This is not the end. This is not the beginning of the end, but rather, this is only the end of the beginning." The markets, for me, remind me of this Churchill quote. I think we are at the beginning of the end, or at the end of the beginning, the end of phase one. Phase one, we had the conclusion, was concluded by the Bear Stearns collapse. Now that wasn't a bailout. Remember, put yourself in the shoes of the shareholders of Bear Stearns. Their shares were valued at $190 in February of 2007, and a few weeks ago they were $10 a share. So it's not a bailout if you ask any shareholder. I think we're at the beginning of phase two of this crisis. We had last Friday the GE earnings shock. Surprised all the analysts. GE was supposed to be immune. Diversified internationally, carefully hedged their portfolios, and their earnings and their projections for the rest of the year were dramatically reduced. The stock went down 12%, which for GE was a huge hit. The credit crisis is now moving from Wall Street to Main Street, and it's affecting the real economy. Now, rather than just unbelievable losses in the derivatives markets that most people are completely unfamiliar with, collateralized debt obligations, credit default swaps, and the like. Now it's the real economy, Main Street. Price-to-earnings ratio, corporate earnings. This is the beginning of phase two. A key component in why GE did so poorly is that GE routinely smooths their earnings to tailor them to their forecasts by conducting large real estate purchases and sales just prior to closing their books every quarter. What happened this quarter was that GE could not close several real estate deals. They had to take real estate losses. This was a material and substantial part of their decline in earnings for the first quarter. Big surprise, so they said. This is the beginning of phase two, because the Fed is going to be adopting a more graduated approach in interest rate policy. So they may let risk simply reprice itself. They want to supply liquidity, but their job is not to determine the overall nominal value of the stock market. The minutes of the March 18, 2008 Federal Reserve meeting were very recently released. There's a 1-month time lag, basically. When they lowered their discount rate and their Fed funds target by 0.75%, as you will recall at that meeting, many people, the markets had priced in a 1-point cut. The Fed was more restrained in their easing than expected. Similarly, those minutes show that there were 2 dissenting votes, 2 FOMC members who objected to the interest rate cuts of 0.75%. The logical inference is that they only supported a 0.5% cut. The Fed and those members particularly stated in their statement a growing concern about about inflation. Inflation has been elevated, and some indicators of inflation expectations have risen. Inflation expectations affiliated with real interest rates. Real interest rates are the spread between the nominal or the given interest rate, the coupon rate of the bond, and the projected inflation rate. And when the markets start demanding an inflation premium, it said that real interest rates are rising. And we've been blessed with a period of declining real interest rates. The markets haven't demanded an inflationary premium, but that's starting to change a little bit, at least in the TIPS bonds, the Treasury inflation protected securities. But that's not a very liquid market, or it isn't as fully liquid as some of the other markets. So, the firm conclusions aren't being drawn yet, but it's a warning. They want to keep inflationary expectations managed. Critical concept, and I'll explore that more very soon in the upcoming videos. The committee expects inflation to moderate in coming quarters, reflecting a projected leveling out of energy and other commodity prices and an easing of pressures on resource utilization. Still, uncertainty about the inflationary outlook has increased. It will be necessary to continue to monitor inflation developments carefully. So the Fed is starting to be clearly concerned about the declining dollar. The risks are rising about a rise in inflationary expectations, where we all start to converse about the rising prices. And they will manage that. So it's the beginning of phase 2. Now I want to deal in some depth in this video with a key speech that Paul Volcker recently made before the Economic Club of New York on April 8th. Paul Volcker is the central banker's central banker. He's a man of enormous stature, not just because he's 6'7" and towers over everyone else, but his reputation and his credibility are unparalleled in the financial world. Greenspan's reputation was never that of Paul Volcker's in terms of credibility. Volcker has done so many things for all of us, frankly. But Greenspan's reputation, although it was clearly elevated, has clearly been tarnished lately. But Volcker remains intact as the most credible figure probably in all of the financial markets. He doesn't speak too much anymore. He's taking a background role. But at a major speech on March 18th, attended by all the movers and shakers in New York finance, it was quite a speech. So I'd like to quote from a few excerpts from it. It's pretty compelling what he had to say. The sheer complexity, opaqueness, and systemic risks embedded in the new markets. Complexities and risks little understood, even by most of those with management responsibilities, has enormously complicated both official and private responses to this current mother of all crises. That's quite a phrase, mother of all crises.